As of 12:17 p.m. GMT-5 on January 21, 2026, Tesla Inc., trading under the ticker TSLA on the NASDAQ, is currently priced at $421.25 per share. This reflects a modest intraday gain of $2, or a 0.48% increase from the opening. While this small upward tick might look like a quiet day for the most talked-about company on Earth, the underlying data suggests a massive coil is being wound tight. If you're looking at your Robinhood app or checking your Fidelity mobile app right now, you might see a sea of green across the Magnificent Seven, but Tesla stock is behaving differently than the others today. While Nvidia stock is reacting to the latest hardware cycle and Apple stock is drifting on services revenue, Tesla is sitting in a high-voltage waiting room. The expectation is that Tesla is merely a car company facing a demand cliff, but the reality is that the company is currently executing a brutal pivot toward high-margin software subscriptions that will essentially make its hardware sales secondary by the end of this year. This 0.48% move today is the definition of consolidation before a storm. With the Q4 2025 earnings report scheduled for release on January 28, just 1 week from today, traders using the Interactive Brokers platform are clearly hedging their bets. The general narrative you'll find on most investing sites is that the glory days are over because annual sales have faced pressure from BYD in China. However, what the average retail investor hasn't noticed is the subtle shift in how Elon Musk is pricing his software. Just last week, it was announced that the one-time $8,000 purchase option for full self-driving would be eliminated after February 14th, moving the entire fleet toward a $99 per month subscription model. This is the Adobe moment for Tesla. By forcing a recurring revenue model, they are drastically increasing the lifetime value of every vehicle on the road. For someone using Schwab Intelligent Portfolios or a similar robo-advisor, these shifts in unit economics aren't always visible in the broad market indexes, but for the self-investing crowd, this is the most important data point of 2026 so far. If you dive into the institutional activity on your Interactive Brokers trading screen, you'll see that the big money is deeply divided. Morgan Stanley recently set a price target of $425, effectively saying the stock is fairly valued right here at $421.25. Meanwhile, Dan Ives over at Wedbush is pounding the table with a $600 target, citing the ramp-up of the Tesla Semi and the imminent launch of unsupervised FSD in Texas. This tension between the car company bears and the AI powerhouse bulls is what creates the volatility that makes online investing in Tesla such a wild ride. Even inside your Fidelity brokerage or SoFi investing accounts, you can see the volume starting to spike as we approach the earnings date. Institutional ownership has remained steady, but the smart money is increasingly focused on the Muskonomy, the idea that Tesla's AI-5 chip and the Optimus Gen 3 bot are going to contribute more to the bottom line than the Model 3 ever did. Today's intraday movement of plus $2 is particularly interesting because it comes amidst news that Tesla is reducing its staff at Giga Berlin by 1,700 employees. In a normal world, a 14% workforce reduction at a major plant would send a stock into a tailspin. But the reality of the 2026 market is that investors are rewarding efficiency over raw headcount. The market sees these layoffs not as a sign of weakness, but as a lean and mean preparation for the robo-taxi rollout. If you are using the SoFi active investing platform, you've likely seen the headlines about Tesla's fleet reaching 7.4 billion cumulative FSD miles. That data is the real moat that competitors like Rivian or even the legacy giants can't touch. Every mile driven today, even on a slow 0.48% day like this, is a mile of training data that brings the company closer to that 10 billion mile threshold Musk says is required for true unsupervised autonomy. Expectation versus reality is the name of the game here. The expectation is that margins will continue to compress as Tesla fights a price war with Chinese EVs. The reality, which we expect to see confirmed on January 28th, is that the energy storage business, the Megapacks, is starting to offset the auto margin decline. If you are using online investment tools to compare Tesla to its peers, you have to look beyond the steering wheel. The energy side of the business is growing at a triple-digit clip, and most analysts still don't know how to model it properly. This is why the stock remains a favorite for those who prefer an individual brokerage over a managed fund. The potential for a sudden, violent re-rating is always there. I want to take a second here and get your take on this. Comment below how many shares of Tesla stock you are currently holding, and tell me, do you think the move to subscription-only FSD is a genius move for revenue, or is it going to alienate the core fan base? The conversation in the comments is usually where we see the first signs of a sentiment shift, so let me know what you're seeing in your own portfolios. To give some perspective for those who are new to this, let's look at the business model and where this company came from. Tesla didn't just appear as a $1.3 trillion giant. It spent a decade proving that electric cars weren't just golf carts, and then another 5 years proving it could actually build them at scale. Today, the SXY lineup, models S, 3, X, and Y is the foundation, but the Cybertruck is the new cultural lightning rod. We even saw Sanjay Dutt driving a Cybertruck in Mumbai this week, even though it wasn't even officially launched in India yet. This global brand power is something that companies like Ford or GM simply cannot replicate, and it's why you see Tesla stock consistently trading at a higher multiple than any other automaker. The core of the current business is transitioning from hardware delivery to software execution. When you use investing sites to look up Tesla's historical performance, you'll see the massive splits and the parabolic runs, but the 2026 version of Tesla is a logistics and AI firm. The Tesla Semi is finally reaching full-scale production in Nevada, with huge contracts from companies like PepsiCo and DHL. This isn't just about selling a truck, it's about owning the charging infrastructure and the autonomous freight network. This is why many long-term investors using Fidelity IRAs or Fidelity Wealth Management have stayed the course through the massive drawdowns of the past few years. They aren't betting on a car, they're betting on the grid. As we look toward the final section of today's analysis, we have to talk about the future outlook and the potential catalysts that could break this $421.25 ceiling. The biggest reality check for the market will be the unsupervised FSD launch in Austin. Reports indicate that robo-taxis are already ferrying employees around Giga Texas without any human safety monitors. If that pilot program goes public in the first half of 2026, the entire bear case for the stock evaporates. You could see a situation where the stock moves from $400 to $600 in a matter of weeks, much like we saw during the 2020 rally. Conversely, the risk is real. If the January 28 earnings report shows that margins have dropped below 14% and that the burn from the AI-5 chip development is higher than expected, we could see a retreat back to the 200-day moving average near $363. For the active traders using the Robinhood app or Robinhood Investments, the strategy right now is wait and see. The stock is currently trading below a tight cluster of moving averages, which usually suggests a breakout is imminent. If it can break and hold above $430 this week, the path to $500 is wide open. But if it loses the $415 level, we might be looking at a deeper correction before the earnings call. This is where having a diversified approach, perhaps through Fidelity ETFs or Fidelity mutual funds, can help dampen the blow of these individual stock swings. But let's be honest, nobody buys Tesla stock for the dampened experience. They buy it for the high beta, high reward potential that only Elon Musk seems to deliver. Looking at the broader sector, the momentum for EVs has shifted toward autonomy or bust. The companies that are just building batteries are struggling. The companies that are building brains, like Tesla and to some extent the NVIDIA stock ecosystem, are the ones catching the bids. If you were doing your own investment help research, notice how the Interactive Brokers platform shows the correlation between Tesla and the broader AI indices getting stronger every day. The company is effectively decoupling from the auto sector and joining the compute sector. This is the ultimate expectation